Who is John
got
Galt?
one thing to say.
Yeah, exactly.
I've heard that one
Funny.
before.
A little Atlas Shrugged reference there.
Yeah,
Yes, and
exactly.
just a quick reminder, we've been involved in crypto since 2013, 2014, and we started with Pantera when Bitcoin was around $100. So
And
we
I was
also have,
involved with crypto. Well, I was involved in cybersecurity with L3 and others at NSA in 2003, 2004, 2008, all those years back when they were talking about IoT and nobody knew what IoT was. And but you know they were putting $11 billion into cyber at that time, and it was quite an undertaking.
and nobody has answered if my Sonos is safe.
Yeah.
Anyway,
It's not.
Oh, thank you. I'm going to tell them.
Yeah.
Yeah, there you go.
And,
So anyway,
and by the way, your wife wants you to pick up eggs and milk on the way home. So we know. So
so do you have
a techie sitting there in a cubicle?
So do you have is Lilian Ting on? Lilian?
Lilian is.
Okay, somehow I've got to get her
Hey, how are you?
Great, we need to see
Lilian, where's your
video.
Can you open your video, please? There you are. Oh,
Perfect.
I am. You can see me?
Great. We're going to change your name to Lilian. Fantastic. Great. So why don't we get started? You've got 45 minutes and looking forward to it. Tell us everything you know in less time than that. Thanks.
Well, we will know. You can get everything out of me in about 30 seconds. I will tell you, I'm Stephen Day Capital Partners, and we're a family office as well. And it goes back to our roots in Florida since our family. I was born in Daytona, as I've told many people, and originally it was founded by a guy that came down from the north with a group of settlers. His last name was Day, and they named the town after him because they liked him a lot, and it was Daytown, like Dayton, because nobody could spell, and they left out the W. And so we've been spreading our genetic defects since 1832 in Florida. So mostly timberlands, dairies, and other kinds of things, but we've now branched out. And most people that know me think of me as mostly in healthcare and life sciences, which is mostly true. But there's other things that we do, including we set up a manufacturing facility in Jacksonville for the fastest growing area of the United States for new home building and new shopping centers and whatnot. The area between the Florida line with Georgia and St. Augustine, Florida, which is extremely fast moving. We set up a manufacturing for construction dumpsters. Boy, that sounds like a really fascinating business, doesn't it? But there was a need. So we look for as state capital, we look for needs. And so we look for markets that are not being penetrated. Hence, that's why I got excited about what Merritt Whedon's doing with Clarity Telehealth, because it was a big hole that was not being met. And I'm a director of that company. And by the way, we are doing a fundraise for that. But and my job as a director is to support the company and also be a thorn in Merritt's side, Merritt. So you'll know. And so the high idea is I own the board of directors society with 11,900 members. So we pay a great deal of attention to corporate governance and the responsibilities of being an outside independent director. So we do pay great attention. And so we find that's extremely important to keep in mind when we're looking at companies. We get about 15 companies a week, plus or minus, that send us pitch decks. 5 years ago, they were sending us business plans, sometimes that were professionally done by somebody else, which we kind of would toss away because we knew that the founders didn't really have any stake in that business plan. They just hired somebody to do it. I'd rather see it actually written on a legal pad and pencil than to have somebody else do your business plan for you. And so we're looking at the kinds of management teams that are experienced, that can bring something to market and carry it forward and make it sustainable. So we're looking for businesses that can scale. We don't do restaurants. We don't do certain kinds of businesses that cannot be scaled. So we're only looking for companies that we feel can expand with the right amount of capital, but with the right amount of management support, and see where it goes. So in that, we also look very carefully at the backgrounds of the people. We look at see what they've done in the past. And it's the old adage you've heard a million times, we bet on the jockey, we don't bet on the horse. You know, we get excited about technology, but we don't invest in technology. We invest in the management team. And so I'm sure you've heard that before. I also own the Healthcare Policy Institute here in Washington, D.C. And we track a lot of things that are going on here and internationally with healthcare. We don't get them all, but we do are able to track and make some sort of impact on certain folks. My company is very interested in rural health. There's 70 million people in America that live in rural counties in America. There are 30 million of those that live 2 hours or more from the closest primary care provider. So we're finding solutions for them through, guess what? Telehealth. And so what we're in the process of doing, and we're working closely with the Deputy Director of the USDA. And who knew the U.S. Department of Agriculture was so heavily involved in health, but they are. And what we're doing is using the volunteer fire departments and their local paramedics because they're the first line of healthcare defense in those communities. They know the frequent flyers. They know who is sick and who doesn't, who uses fentanyl and who doesn't, who's got diabetes and who doesn't. And they know the patients more than a doctor that's 2 hours away that sees the patient for 4 minutes on an average, and then it sends them home for another 2-hour drive. So we're working very closely with them. They can go because there's broadband issues, as you guys talked about in the past. We can put them in a secure telehealth location in a fire station and within privacy. The paramedic or the EMT can take their vitals and transmit that to the doctor at the other end. And then the patient can see the doctor in privacy, totally HIPAA approved. So we're doing some interesting things that we get excited about. And we're very excited about how we can make a difference in the rural areas. So, but let's talk about the kinds of things that we look at when companies come to us. One, is there competition? And we get amazingly large number of people that tell us, no, there is no competition. Well, we know that's patently untrue. They don't know. I'm a National Science Foundation life science mentor at George Washington University and other universities. And it amazes me that the life science researchers don't even know that another university within the same state or within the same area is doing the same research, exactly on the same problem. And amazingly, they don't Google. I mean, you know, like these guys are post PhDs and they don't Google, you know, and figure out who else is doing what. It's amazing. But one of the things that we are very careful about is understanding with licensing technologies from universities or research centers, or with working with folks that are researchers only and without having business experience, is that they often don't understand the difference between grants and investment. And that's a big deal. That's a really big deal. And so, you know, my job as a mentor for the National Science Foundation is to bring reality and be the adult in the room. That's not always welcomed. But when we look at companies, when we get a business plan, and I'm still a great believer in business plans, not just pitch decks. I really want to understand that the companies fall through a lot of issues, including little things like liability insurance. You know, a pitch deck doesn't have that. I want to see that they fall through the other kinds of little insurance and little risk issues that maybe a business plan will help them through. Now, that's not too much to ask, but that's what I insist upon. And when we do things, what we do, if we write a term sheet, we take 4 full months for due diligence. Now, that seems like a very, very long time for most people, and it is. And I'm quite often very criticized for that. And as you can tell, I'm emotionally fragile and it hurts my feelings. But the problem is that I do it for a reason, and we've learned some hard lessons. When, first of all, we're not there to rescue anybody. We're interested in helping them grow. And it takes us just a few days to review the financials. That doesn't take us long. If we've got questions, we go back and forth on the question. But the financials are pretty easy to evaluate. What those financials do not tell us is the work ethic of the team. If the CEO is a control freak, if the COO is just there in name only, if the CTO or the chief revenue officer or the chief medical officer perhaps is really still kind of out of touch with how things are really going on. You know, so we want to look at every single member of that team. And we really want to feel good about all those members. You know, so we pay attention to the team, not just the CEO, but we do pay, of course, the most attention to the CEO. And we also help them set up a board if they've not already set up a board. And a big red flag, and it should be for everybody that invests, is looking at the board. Do they have a board that's a functional, independent board, or do they have the typical founders board of their buddies? And if they've got that, you know, then we ask them to revise the board and maybe, you know, pull people off. We really believe that there's only one person in the company that should be on the board, and that's the CEO. Everybody else, regardless of their position, should not be on the board of directors. Everybody else should be independent. We know a little bit about corporate governance. Okay, and so the other thing is when a CEO is resistant to creating a board, and by the way, we train boards. We train the Farm Credit Bank boards, and so we have quite experience dealing with boards and, you know, around the country. But I will tell you that when a CEO is resistant to having a board, it tells us something right away. It tells us that that board, that CEO is probably a control freak. He's afraid of having a boss. You know, he's afraid of losing control. He's afraid of having somebody else insist that he do things the right way. And we won't have that, okay? So, and we insist on having board meetings where we can all get together and not just do it by phone, but all get together and have a discussion about any issue that comes up. You know, so we're very interested in having a really strong board, even though it may even be a pre-revenue company. You know, but we really believe that we bring value to a board, and we usually insist upon being on the board unless they've got just a strong board already. And I'm not smarter than a lot of the other people out there, and therefore, if they've got a strong board that looks like they're really able to contribute, then I don't have any problem. If they've got a board where the people were just brought in to have a board and they're not doing anything, they're not helping raise capital, they're not bringing in new clients or new customers, or they're not bringing their Rolodex of industry folks, then we have to have a discussion about that. You know, why are they there? You know, so, you know, there is liability for being on a board. We understand that. And we're not trying to keep and kick people off the boards, but if they're going to be on the board, they ought to be doing something to help that company grow. So in that, when we look at companies, You know, we look at the idea that we can help them grow, not just with an infusion of cash, but with our business acumen and our industry knowledge and our Rolodex. And if, you know, and with those three things, we think we bring a lot of value to any new startup or any company that is just beyond startup stage, say 3 to 45 years down the road. So with that, that's what we do. And so I will now ask Carol Mann to join us. And Carol is kind of a fixer. She kind of comes in and takes and helps companies that are in trouble. Whereas I would just come in with an assault weapon and fire away. Carol comes in and more diplomatically helps companies get out of the trouble they're in. But Carol, why don't you tell them about yourself?
Good morning. Thank you. Thank you for inviting me. Yes, my practice has always been half high growth companies and half turnarounds. And that's because there are companies that have the same issues. They lack depth of capital sometimes, they lack professional management, they don't have key performance indicators that they've really fleshed out. Sometimes they don't have a good go-to-market strategy. So the work is really the same for both ends of the spectrum, and a startup can become a turnaround in a New York minute. So we're trying to help them avoid that problem. So we'll either do consulting. Sometimes if it's a crisis situation, an owner has passed away, the bank has requested new leadership, I'll do interim CEO work. And then my group has just started to invest in companies in the last 2 years as well. So we come from a sort of a global viewpoint. And I would agree with many of the things that Stephen said. We tend to take 90 days to do the due diligence to get to close, but we're very quick to go to a letter of intent. The reason we do that is because we feel that once someone's under a letter of intent, they're more free to share even the things that they didn't think they should have. So I think that we share a similar investment thesis as Lilian. So maybe Lilian, if you talk about it, that's a good handoff to you.
Great. Well, so we, Stephen said many of the same things that we're looking for. One is, we look for who's running. Everyone in our group has been operators before, so we are getting people that we know, that we've worked with in the past. So in terms of due diligence, part of that due diligence is there because we know people and people are referring others that they've worked with to us. So the partners have exited companies up to $1 billion. So, there's a lot of connections in the startup world. So we have really good deal flow. And in terms of our thesis, in terms of the industry, we actually invest in any SaaS company. We're industry agnostic. We tend to have a focus on fintech, transportation, and sales. But that being said, we're looking at the opportunity, and we invest very early on. So this was our first fund. We raised it very quickly, just a friends and family round. We put in check sizes of $250,000 in these companies. Usually we're the first institutional investor in. And this space is actually a very opportune space because it's too small for VCs and too big for angels. So this is a very difficult, kind of cash amount for startups to get. They're still a little too risky for larger check sizes. And then again, angels, it's harder for them to have that type of cash flow. And this enables us to get to know the companies early and then advise them because we've all been operators before and grow with them. And that thesis has worked really well for us. We invested in, there's actually 2 companies that are doing very well. One just got a term sheet for over $1 billion. Another one was listed, and it's also exiting on Forbes top 50 fintech companies. So Carol, like, back to you.
Yeah, that's great. We feel the same thing about the opportunity in this space and companies of this size. It is difficult for them to get financing. We work almost completely by referral, the same thing. And we are also a group of operators. So we have public company experience, SPAC experience, and we're really looking for that opportunistic device, piece of software. We're not only SaaS investors like you are. We do manufacturing, medical devices, any type of technology that we think, given our group of groupthink experience, has legs. And we do small investment the same, about $250,000, same kind of thing. And then we will come in for later rounds. So we like to spend a lot of time getting to know the leadership of the company. And we're very active investors. If you think back to the old days of merchant banking, where we really take an active role, that's the way that we operate. And that 90 days of due diligence, back to Stephen's point, where you spend 4 months, we get to letter of intent very quickly. And then we have up to 6 months to finish our due diligence. We usually do it in 90 days, but we want that time also to get to know them and see how they respond to things that don't go their way, and are they willing to take guidance. So Stephen, I think that's did you talk about your deal size? Oh, I'm sorry about that.
Oh, I was actually saying that's the point about getting to know a company is a great point. One of the things that we do is, because we write such a smaller check size, we get to know the companies early on, when it's easier to form a relationship with the company, with the leadership, and then grow with them. So we know how they're doing, we know what their problems are, we're advising them. And then, as they grow to that $1 billion check size, we can continually provide advice to them because we have that trust and we know what's going on. So we can add additional money into that investment. We do a lot of follow-on investment.
Yeah, I would agree with the same thing. And we also take a position either on the board or the advisory board, depending on the structure of the company. And we like to be able to bring specialists in to attend to whatever difficulties we see. Foreshadowing or forethought from our experience is something that the people we work with find very valuable, because when it's your first company and you're looking for investment, you can think a pothole is a sinkhole. So the leadership and the board have a way of saying, oh, that's not a small problem, that's a huge problem. We just don't want you to fall in and have to dig you out. So sort of preemptive striking is an important way that we try to question management, lead them, educate them, and provide resources that they may not have access to because of their, sort of junior experience in running a business. We always say that we'll invest in early stage, but they have to be in the business of their business. It can't be a great idea. It has to be in revenue. And we prefer 5 to 8 years, sometimes earlier, sometimes later, depending on, with COVID, that's changed a little bit. It's usually 3 to 5 years, but with COVID, for some companies, they didn't make a lot of progress during that period of time. And we like to be able to provide them with industry expertise that they may not be able to access. And we find that's something they feel is almost as valuable as the money itself, which I'm sure both Stephen and Lilian's groups find the same thing happening.
Exactly. Well, let me
definitely.
Let me bring in something in here as well. This is supposed to be a venture capital panel, but in reality, the impact of venture capitalists has really waned in the last few years to angels and super angels, particularly out in Silicon Valley, where angels were people have made so much money from their exits in a lot of the public social media companies and whatever, that there's a whole brand of super angels that are making money and putting investments in things that normally people would go on to venture capital companies for. And in reality, unfortunately, most the founders are happier with the angels than they are with the negative view of venture funds, because ventures in the past have really had a short-sighted view. Let's get in for 3 years, get our fanny out, and let a PE company take it over, or have some sort of other liquidity event so we can be out and get our money back out and keep investing. We don't look at the world like that, and we, I mean, dear Lord, it's really unfair to put that kind of pressure on a company that we believe in. So, and we want to believe in the companies we invest in. I'll give you an example of something that has happened and how we get involved. A few years ago, I was about, I don't know, 10 or 12 years ago, somewhat of it is, I was the chairman of the board of a maritime security company that was based in Miami. And at one point, and my partner in that was John Ashcroft, the former attorney general, senator from Missouri, and a very bad guitar player. And, but the CEO was a former special ops guy out of the Coast Guard. People don't realize the Coast Guard's got special ops, but they imagine going into rough seas at night, boarding ships in the Caribbean to look for drugs and human trafficking. And that's what he did. And he got an MBA from Georgetown. Okay, so he's got all the qualifications that it sounds perfect, right? Perfect resume. Except that after a while, we realized that he would not sell. He could not sell. And he had two partners, one of which turned out to be schizophrenic. And we found that out actually during that 4-month period that I was telling you about for due diligence, because the guy went a little nuts and had to be hospitalized. So we saw that problem. He didn't lose his equity, but he lost his operating ability because we just couldn't have that. But the CEO, we didn't realize that for a little while. And the problem is that he would use every excuse in the world not to call on accounts. And basically, in the easiest accounts, the lowest hanging fruit, here's a guy that boarded people, narcotics ships, for God's sakes, in the middle of the night. And so, but he was afraid to make a call and get rejected. So, and he was always scheduling. He said, well, I've got to spend my time payroll. I've got to spend my time doing accounting. I've got to do all my scheduling. I don't have time. And Carol made a point that she likes to bring in outside advisors or outside consultants. I am all for outsourcing payroll and HR and anything else you can outsource, at all for a startup. I think all startups need to figure out what they have to do in-house and what they can do outsource. And we look at two things. Is it revenue producing? Do it. If it's non-revenue producing, outsource it. Okay. So I actually set up a whole separate little company in Miami to do the bookkeeping, to do the scheduling, and do the HR work for them. So he had no excuse. We finally had to replace him because he still wouldn't go out and do what he needed to do to talk to people, and who would think, right? But
actually, we find that to be a really common problem. They're expert at what they know, but the business of running a business is not their expertise. And we find it's sometimes helpful to bring in a chief revenue officer, which you can do as a fractional sort of outsourced service, to either side by side sit with the owner and do the part they don't like to do of the sales process, but keep the founder, who usually has the technical expertise, as part of that team. And we find that that's a really useful solution to that problem sometimes.
Well, it helps. It really does. And one of the things that we've also seen that that if we don't provide a metrics to be met, then I can't rely always on the revenue officer or the CEO or whoever to create the metrics. Well, like in the company Clarity I've mentioned to you, they have a marching plan. I mean, they're on a march, and I don't have to worry about that. But some do, and you know it. And particularly in manufacturing and even in IT, you know, I mean, some of the things, I mean, people can't stop programming, people can't stop engineering, you know, they never get a product out and they don't trust the public to guide them to just enough. And so just enough is what I'm always looking for, you know, instead of, I mean, let's take an example of Word. Do you use every facet of Word, everything that Word can do? I don't even know them all, but I get through Word, you know, I can do what I need to do on Word, but there's dozens and maybe hundreds of different things that you can do with Word that I don't know about, but they don't need to keep adding, but typically programmers and software people keep doing that. And same thing with EMRs, electronic medical records, and other things. There's a lot of stuff that doesn't have to be done. So
Stephen, I think you make a really good point there.
Right.
In terms of metrics, so one of the things that we also do is like we help them set, like, what are your target metrics? What are the highest priorities? Because you're right, it's very easy to start chasing after all the bright lights. And you know, one of the ways that we do that is through milestone investing. Like if you reach a certain milestone in sort of sales, et cetera, then you get another segment of funding. So I think that's a great thing that you highlight.
Well, I need to switch gears though, because we've got another panelist that we've not heard of. It's sitting there patiently, Randy. And I've known Randy for a couple of years. And Randy is, there you are. Look at that beard. I hadn't seen Randy in this beard before. But
Yeah.
Randy has great credentials, which I don't have. You know, I'm basically, you know, as I tell people, I spoke to a group of healthcare executives and doctors a few years ago at the Georgetown Club in DC. And I looked out at them and I said, you know, everybody here is an MD or a PhD, but I don't feel out of place because I'm probably about 3 weeks away from getting my GED. And they're all looking at each other and saying, I believe he's serious, you know? And so anyway, but Randy and his partner have created a very interesting format for investment. Can you tell us about your program, Randy? I'm sorry we've been holding you all.
That's okay. No, it was very interesting, Stephen. Thanks so much. Yeah, I started the Private Access Network 5 years ago after being a venture capitalist and a fund of funds guy for about 20 years. And my partner and I, who was the president of the Motley Fool for 12 years, have essentially a fundless sponsor model where Scott and I are looking for emerging technology companies. We've built a portfolio of 13 over the last 6 years. And after we decide to invest our own money, we open it up to our network, which is 85 family offices and high net worth individuals who are, quote, members of the Private Access Network. And so the deal with them is they've signed up to see our deal flow. They don't want to see the deals we're not doing. And when we've decided to write our own checks into these companies is when we share the deals. And so we're investing anywhere from $500,000 to $1.5 million in rounds that are anywhere typically from $5 million to $25 million. And then we're also doing a lot of follow-on investing. So we just wrote a check. We just wrote our 4th check into a healthcare services company earlier this summer. And we're just about to write our 3rd check into a company. And we wrote another 3rd check in June. And so we're doing way more follow-on investing than we ever thought, which is great because, you know, people do come and go from the network. And so if they haven't seen a certain deal, they can invest at a higher price, but they, you know, they can get in at a later date. Yeah, so it's been a lot of fun. And, you know, it's kind of exactly what the doctor ordered for these people. We don't claim to be their only source for venture capital deals. A lot of these people are in funds. Most of them are CXOs of technology companies themselves. And this is just a way to, you know, write a check on a deal by deal basis that's exactly the size of check they want. If they're busy or illiquid or they don't like the deal for some reason, there's absolutely no commitment to do it. So it works out really nice. And then again, as I mentioned, Scott and I are doing all the deals. And so we've got a nice little portfolio with 13 companies at this point.
It's a great
You
business
know,
model.
You want to talk about any particular deals that have been just outstanding for you guys? Can you share?
Yeah, I'll just mention one deal. I'll just mention one deal. They're in the food catering business, and they were growing 100% a year when COVID hit. And this is an interesting story because when COVID hit, their business literally dried up in days, and they went from doing a little over $1 million a month to zero. And two kind of aspects. Number one, it was quick. And I think that was tremendously helpful, because if they had kind of died a, slow, painful death over 6 or 12 months, maybe they wouldn't have recovered. But two things played out. One, it was insanely quick, so they could immediately, we're put in the position of what do we do? And two, it really caused the management team to rise to the occasion. And so literally within a couple of weeks, they switched their business from in-person only food catering to online only virtual experiences with chefs and sommeliers and other type of artisans. And so by June of last year, they were already doing they had already eclipsed the revenue from January. And by the end of the year, they were already double the size that they were in January of that year. So if you only had looked back in January of this year, you would have said, wow, what, no hiccups at all. The company's twice the size. And like I said, it was a testament to both the mettle of the management team and just the sheer, compacted time frame that they had to pivot. So that was a very positive story for us. And as you guys have all said, it was because of the management team. If they called us and said, Randy, you got to get us out of this mess, I'm not sure we would have been prepared to do that, able to do that.
You're talking about Hungary?
I am.
Yeah, I mean, that's an amazing story, and Hungary has an incredible investor base, including what's it, a bunch of other big stars, and it's incredible. What happened to them. But it's also sad because they've had the company and the CEO, both Randy and I know him, the CEO was smart enough to figure out how to change gears really quickly. And that's brilliant. That's really brilliant. So, but, in a year from now, they'll be up. And their principal business was providing chefs and food for like corporate events, right?
Yep.
And so, but I absolutely believe they'll be up. I'm not an investor, you are, but I'm a great fan, and I know the CEO and his wife. I mean, they're wonderful. So, but then we see other companies like Seth Goldman, Beyond Meat.
Sure.
He started Honest Tea, and Honest Tea was started in his kitchen sink, and he built it with his wife and sold it to Coca-Cola. And then then he started, he's now the executive chairman of Beyond Meat. And so, but he lives here in Chevy Chase, Maryland. And so, brilliant guy. And now he's doing other kinds of things that are vegan-based things. I mean, my problem is I can't pass up a beef taco. But the thing is that but you see innovation by people like that, Randy, and how can you not want to support and work with them? So what do you look for in deals?
Yeah, well, similar to the other people that have spoken, we look for extremely competent management teams, right? We're not looking for, projects, right? We're not looking for consulting gigs. So what we do well is due diligence. And so after we write a check into a company, we got to move on and look for the next company. And we can't be calling that executive team, every other day or even every other week and ask, and that's how it's going. So we look for, people that are self-sufficient. And so Hungary's a great example, because I'll tell you, Stephen, we were kind of not sure how to interpret this in the beginning, because as you mentioned, they have probably 15 celebrity investors. And we kind of said, well, wouldn't it be better if there were 15 other well-known venture capital firms in here? And of course they have that too. But we said, why are they spending their time with all these celebrities? And it turns out that was the best thing they ever could have done. And just the mere fact that they could get 15 celebrities on the phone just showed what they were capable of as executives. And so, you know, the lesson for us going forward is anyone you can get into your deal that's got a name, A, get them in, and B, it just shows your ability to get stuff done. So that's the, it's been
Let
kind
me
of a
just follow
theme.
up on
I
that
mean,
point. I think that's great.
Sure.
Mhm.
Sure.
Yeah,
Hey,
that's
guys,
also what
we have a
do
limited
too.
amount of time left. Can I jump in with a question? So I just wanted to ask about how do you guys like structure deals in terms of participation from LPs in the fund and co-investment? Is there like, so we do a lot of Silicon Valley stuff, and in Silicon Valley, we find that, I mean, the numbers are like 5 to 10 co-investment X versus
Yes.
like New York is about 50% to 1X co-investment. Where do you guys land in the whole space?
Closer to Silicon Valley for us. We would prefer to have a lot of co-investment and a lot of shareholders and a lot of people active in it, because not only do they bring investment, they bring interest, they bring their connections, they bring their relationships. And, you know, anytime you've got a larger number and pool of investors, and it's better really for the founders, you know, as opposed to, you know, the whole idea that, remember the term for venture capitalists was always the vulture capitalists, right? So, you know, the whole idea, and like for Randy's thing, I don't consider that really a venture capital thing. It's a really unique situation. But you know, like people were put off by the controls that VCs would put on, whereas, you know, we don't do that. You know, we want to have a board seat where we want to be in this, we want to be in that, and we're going to be proactive. No, there's no mistake about that. But to put demands on the company, except for good governance and understanding metrics and understanding good reporting to us, because we're going to demand that, I can tell you.
So you had mentioned earlier, like super angels and angel groups, et cetera, and obviously
there's a place at the table for everybody. Okay.
Right. So what do you think about crowdfunding? Any thoughts on that? I mean, on the one hand, crowdfunding has expanded greatly, but on the other hand, it seems like there's a lot more regulatory aspects on top of it. Any thoughts?
Yeah, and okay, and first of all, I'm not a big fan of FINRA, because FINRA wants to control everything, you know, and the problem is that the crowdfunding was really designed so small companies could get funded without going for a big song and dance. And they've tried to say, okay, but we've got to protect ourselves. FINRA did, you know, all our registered reps and our brokerage things. But the SEC, and I've been attending the Small Business Capitalization Forum for years, until the last 3 years actually. And the SEC is well aware that brokerage houses and registered reps are not going to sell stock for companies that are not on a board or not on exchange. They are not even allowed to, by most brokerage houses, to be able to talk about things that are not liquid on a board. So that leaves finders and people like us that we invest, but we also help raise capital, you know, in a very hard, energetic way, and it's exhausting at times, right? So, but I like the idea of the concept of C and A getting out there and bringing in, letting small investors put $100 or $500 or $1,000. Why should they be left out of the loop? You know, instead of us accredited investors, why shouldn't the small guy have an opportunity? Right?
I understand. Yeah, absolutely. It makes perfect sense. Guys, we are out of time, but can we get closing statements from everybody for 30 seconds or less? And then we got to move on to Brian Anderson. Stephen, can I get a closing statement and then the rest of your panel?
Surely. Thank you so much for all this, what you've done. Tom Shea, it's your name's down there with a different name. And for Randy and Carol and Lilian. And quite frankly, I've enjoyed the first two panels, of all three panels actually, a great deal. And so I really appreciate the opportunity to be here with you guys. And please, my connection, my LinkedIn connection is up there in the chat thing. Help yourself to it. I would welcome any comments and any conversation about Clarity Help with Merit. And you can contact Merit directly, or you can contact me, and I'll get Merit and me together with you guys to talk about what's really going on there. And Carol and Lilian and Randy, luckily I've got a panel of really good, great achievers. So thank you so much for setting that up. Tom Shea.
Great. Can you guys all, do you have closing statements, Carol? Randy?
Closing statement is that since we have turnaround experience, we do think sometimes the distressed companies are a good opportunity, and we can invest in a unique way through an Article 9 sale. So we think there will be more of those opportunities coming up, and we are anxious for those as well.
Perfect.
Thank you for
Lilian?
the opportunity.
Randy?
Yeah, so just encourage everyone to keep looking at deals. I think it's great. It's a great way to make money and have fun. And if anyone knows, some winners that need $500,000 to $1.5 million, feel free to let us know.
So great, looking for winners. Keep on going.
Yeah.
Lilian? That's my favorite.
Yeah, make it easy for us.
Lilian, you there?
Yes. Yeah, I would say, yeah, we're always looking for winners as well, building that relationship long term. So when they're ready for an investment, like we know they're both self-sufficient and they're willing to like be coachable. We can connect them with the right people, with the right industries, companies, investors, and then looking to syndicate. So I think having those, all those components together really make a good deal. It's like having that combination of other people who have looked into it, have the connections, want to invest, have a team that's self-sufficient, like those combined
Okay.
makes a good team.
Yep. Well, fantastic. Listen, great job, guys. Thank you so much.
Thank you.